£200. That is the amount many eligible UK pensioners could miss this winter if they reach September without taking the right step. And there is another deadline that arrives even sooner, one that could affect how much you receive, how much tax you pay, and whether a payment you are expecting actually reaches you. September is not just another month for pensioners. The qualifying week for the 2026-27 winter fuel payment is scheduled for the 21st to the 27th of September. And what happens before that week can make a real difference. The key point is simple. If you think you may qualify for pension credit or another qualifying means-tested benefit, do not leave the check until September is already underway. And stay with me, because the winter fuel payment is only the first part of this. There are several changes and deadlines connected to HMRC, DWP payments, tax, state pension increases, and care costs. One of them could affect your money without you receiving a dramatic warning beforehand. The first thing you need to check before September is pension credit. For the 2026-27 winter fuel payment, the qualifying week is the 21st through the 27th of September. According to the information in our source material, eligible pensioners may receive £200, with £300 applying to those born before September 1946. But the important detail is not simply your age. You need to be receiving pension credit or another qualifying means-tested benefit during that specific qualifying week. That means submitting an application is not necessarily the same thing as being in payment. If you are eligible for pension credit but have never claimed it, September is not the time to assume you can sort everything out later. The source material says pension credit can take around 6 to 8 weeks to process, which makes acting before the qualifying week especially important. And this is where many pensioners make a mistake. They look at their weekly income, decide they probably earn too much, and never check whether they actually qualify. But entitlement can depend on more than one simple income figure. Savings, circumstances, and other factors can matter. So if you are over state pension age and your household finances are tight, check your pension credit position now. Do not wait until the winter fuel payment becomes the reason you finally look into it. There's also a second side to the winter fuel payment that is easy to overlook. If your income is above the relevant level, the payment may have tax consequences. The source material says that pensioners with income above £35,000 may have the winter fuel payment recovered through their tax code. It also gives the opt-out deadline as 11:59 p.m. on the 20th of September 2026. So before September arrives, look at your total income and ask yourself a simple question. Am I expecting a winter fuel payment? And if I receive it, could it be recovered through tax? Do not assume that receiving money automatically means keeping the full amount. And do not assume that opting out is always the best decision either. Your individual circumstances matter. The important thing is knowing the deadline before it passes. Now, the next issue is quieter, but it could affect far more pensioners over time. The state pension increased by 4.8% from April 2026, according to the source material. At the same time, the personal allowance is frozen at £12,570 until 2031. That creates an unusual situation. The full new state pension is now extremely close to the personal allowance. The source material places the full new state pension at £12,547.60 a year, leaving only a small gap before additional taxable income becomes relevant. So if you receive a small private pension, savings interest, or another source of taxable income, you cannot simply look at your state pension in isolation. You need to look at the total picture. This is where some pensioners can suddenly notice that their private pension payment is lower than expected. HMRC can adjust tax codes, and pension providers can then deduct the additional tax automatically. If this happens to you, do not simply assume your pension provider has made a mistake. Check the tax code. Check the income HMRC has on record. Check whether savings interest or another source of income has been included correctly. And if you receive a letter from HMRC, open it. That sounds obvious, but it matters. The source material says HMRC sent more than 1.3 million simple assessment letters in the last reported year. As the state pension rises while the personal allowance remains frozen, more pensioners can find themselves having to deal with tax calculations they did not expect. This is also why the weeks before September are a good time to review your savings. If you hold savings in an ordinary savings account, check how much interest you are receiving and whether moving appropriate savings into a cash ISA could reduce future tax on interest. Interest earned inside an ISA is tax-free, subject to the applicable ISA rules and allowance. The key is not to make a rushed financial decision simply because you heard the words tax-free. Look at your full circumstances first. But there is another September development that is particularly important because it does not necessarily involve a form arriving at your house. It involves the number that helps determine the next state pension increase. September is when the economic data used for the following year's triple lock calculation becomes especially important. The April 2027 increase is expected to be based on whichever is highest under the triple lock formula. The relevant September inflation figure, average earnings growth for the specified period, or 2.5%. The source material uses an early wage growth estimate of around 4.2% and says September CPI could be around 3.4% to 3.7%. If the relevant wage growth figure remains higher, that could point toward an increase of around 4.2% for April 2027. But remember this, it is not the final confirmed figure. The final number depends on the official data and the government's subsequent confirmation. So why should you care about a number that has not even been finalized yet? Because even a percentage point can become meaningful over years of retirement. On a full state pension, a 4.2% increase would add roughly 10 pounds a week, based on the figures in the source material. Over a year, that is hundreds of pounds. And that is why September matters. The number being measured now can influence what your state pension looks like from April 2027. But there is a bigger issue sitting underneath all of this. A higher state pension sounds like nothing but good news. Yet, when your personal allowance stays frozen, additional income can push more of your retirement income into tax. So pensioners need to look at both sides of the equation. What is coming in and what HMRC may take back. Now, before we move into the next group of changes, think about your own situation for a moment. Do you receive pension credit? Do you receive the state pension alongside a private pension? Do you have savings producing interest? Have you received a letter from HMRC that you have not yet opened? Or have you simply assumed that because your pension is paid automatically, every part of your retirement income is automatically correct? That assumption can be expensive. And the next issue is one that many pensioners do not think about until their family is already facing a difficult decision: care costs. The source material says the government is reviewing the future of the proposed £86,000 lifetime social care cap, with a clearer indication expected around September. The important warning is not to make financial plans on the assumption that the proposed protection will definitely arrive exactly as previously expected. The current position needs to be understood on its own terms. In England, the source material states that if your assets, including your home, exceed £23,250, you may be expected to fund your care costs yourself under the current means-tested framework. And care is not cheap. The source material gives an average residential care cost of roughly £1,200 to £1,500 a week. That means a pensioner who assumes future government protection will automatically cover the difference could be making a very risky assumption. If care planning is relevant to you or your family, September is a good time to review the current rules rather than relying on promises about what may happen later. And there is one more practical September point that sounds small but can prevent confusion. Unlike August, September has no bank holiday affecting the normal DWP payment schedule. So payments due in September should arrive according to their scheduled dates, rather than being moved early because of a bank holiday. The source material also explains the usual weekday pattern based on the final two digits of the national insurance number. 00 to 19 on Monday, 20 to 39 on Tuesday, 40 to 59 on Wednesday, 60 to 79 on Thursday, and 80 to 99 on Friday. So if you received a payment earlier than expected around the August bank holiday and suddenly find yourself facing a longer gap, remember that September returns to the normal schedule. But that is not the end of the September story, because while pensioners are checking winter fuel payment, tax, and state pension figures, DWP is also dealing with another issue that can create serious financial problems: overpayments. And if you receive a letter saying you have been overpaid, the worst thing you can do is put it aside and hope it disappears. That is where we need to go next. £16,000. That is the savings figure you need to understand if you receive certain means-tested benefits, because changes in your capital can affect your entitlement and may trigger questions from the DWP. The important point is not to panic. It is to understand what you are required to report and to make sure your records match your real circumstances. The source material describes new bank monitoring powers being extended to existing pension credit and housing benefit claimants. Under the information provided, banks can flag accounts where balances appear to exceed the relevant eligibility thresholds. So imagine you receive pension credit, and earlier in the year, you received a lump sum from an inheritance, property sale, or pension withdrawal. Your savings temporarily rise above £16,000, but you never tell the DWP because you assume it is only temporary. That is exactly the kind of situation you should review. The source material says changes to savings or capital, changes of address, periods outside Great Britain of more than 4 weeks, and changes in income can all be relevant to what you need to report. The action here is simple. If your circumstances have changed, check your benefit conditions and report the change rather than waiting for the DWP to discover it through another source. Why? Because an issue discovered later can potentially turn into an overpayment calculation covering a much longer period. And that brings us to one of the most important things to remember before September. A letter from the DWP is not something to ignore. The source material refers to hundreds of thousands of overpayment cases, including cases attributed to official error. It also explains that even when an overpayment resulted from a DWP mistake, recovery may still be pursued under the current rules. That sounds frightening, but there is something important you should know. If you receive an overpayment decision and believe it is wrong, you have a process for challenging it. The source material says you generally have 1 month from the date of the decision to request a mandatory reconsideration. That means you are asking the DWP to look at the decision again. Do not wait until the deadline is almost over. Read the letter carefully. Check the amount. Check the dates. Check the reason for the alleged overpayment. Then consider whether you need to request a mandatory reconsideration. And if paying the amount would cause genuine financial hardship, the source material says there may also be circumstances in which the debt can be considered for write-off. The important lesson is this. Receiving a repayment demand does not mean you should automatically accept every figure without checking it. The next change involves PIP. And this one is particularly important for anyone receiving personal independence payment. The source material says The DWP changed the review process from June 2026, with longer minimum periods between PIP award reviews for many existing claimants aged 25 and over. That could mean fewer frequent reviews for people whose conditions are unlikely to improve. For some claimants, that is potentially welcome news. But there is a detail many people could misunderstand. A longer review period does not mean you can simply forget about changes in your circumstances. If your condition has become worse and your existing award no longer reflects the support you need, the source material says you can ask for a review. And if your circumstances have improved in a way that affects your entitlement, you may have an obligation to report that change. Nobody should assume that a longer review period means the award can never change. So if you receive PIP before September arrives, ask yourself one question. Does my current award still accurately reflect my circumstances? If the answer is no, get advice about the correct next step. Now let me bring all of this together with a simple example. Imagine Brian, a retired pensioner who receives his state pension, has a small private pension, and keeps a reasonable amount of savings in the bank. He sees a headline about September and thinks, nothing here applies to me. My state pension is automatic. But then he checks his paperwork. He discovers that he may be eligible for pension credit but has never claimed it. He also notices that his private pension tax code has changed. Then he remembers that his savings produced more interest this year than they did previously. None of these things look dramatic individually. Together, they can change his financial position. That is why September preparation matters. It is not about being frightened by every government announcement. It is about checking the small details before they become expensive problems. And there is another date you should keep in mind. The source material says, the exact April 2027 triple lock figure is expected to be confirmed at the autumn statement on the 28th of October 2026. So September is important because the underlying data is being established. But October is when you should expect the final confirmed figure to become clearer. That distinction matters. Do not let anyone tell you that a forecast is already the final state pension increase. A forecast is a forecast. Now think about your care position. If you own a home and have never considered what would happen if you needed residential care, do not assume the proposed 86,000 pounds cap will solve everything. The source material says the social care review is expected to give a clearer indication of the government's position. Until the rules actually change, plan around the rules that currently apply. This is especially important for families because care decisions can happen very quickly. A pensioner may suddenly need support. The family may be trying to understand the value of the home, savings, and other assets, while also trying to arrange care. Having the conversation earlier is much easier than having it during a crisis. And if you are waiting for a DWP payment in September, remember the practical point we discussed earlier. There are no bank holidays in September that shift the normal DWP payment schedule in the way the August bank holiday did. That means you should generally expect payments to follow their normal schedule. So here is the full picture. Before September, check whether you could qualify for pension credit, especially if you want to be in payment during the winter fuel payment qualifying week from the 21st to the 27th of September. If your income is above the relevant level and you receive winter fuel payment, check the information about the 20th September opt-out deadline. Review your tax position. Because the state pension has risen while the 12,570 pounds personal allowance remains frozen. If you receive private pension income or savings interest, make sure HMRC has the correct information. Keep an eye on the September inflation and earnings figures because they feed into the calculation used for the April 2027 triple lock. If care costs could affect you or your family, do not build your financial plans around a proposed future cap. Check the rules currently in force and get appropriate advice. If you receive pension credit or housing benefit, review any changes to savings, capital, income, address, or time spent outside Great Britain. And make sure you have reported anything you were required to report. If a DWP overpayment letter arrives, do not put it in a drawer. Check the decision and remember that the source material identifies a 1-month period for requesting mandatory reconsideration. And if you receive PIP, make sure your current award still reflects your actual circumstances. September is therefore not simply about one new rule. It is about several moving pieces arriving at the same time. And the biggest mistake would be waiting until a payment disappears, a tax letter arrives, or a DWP decision lands before you start checking. You have time to prepare. So take 10 minutes this week, find your latest DWP letters, find your HMRC correspondence, check your pension credit position if you think you may qualify. Look at your savings and income. Check whether anything has changed since your last benefit assessment. Then write down the important dates. The 20th of September for the winter fuel payment opt-out deadline, described in the source material. The 21st to the 27th of September for the winter fuel payment qualifying week. September for the data that feeds into the April 2027 triple lock calculation. And the 28th of October for the expected confirmation of the final state pension increase. Those dates are much easier to manage when you know about them in advance. And remember, not every pensioner will be affected by every change. Your age, income, savings, benefits, and personal circumstances determine which rules apply to you. So do not make a major financial decision based on a headline alone. Check your own position. If you know someone who is already retired, send this video to them before September begins. A parent, grandparent, neighbor, or friend may have received a letter they have not opened or may qualify for support they have never checked. And subscribe if you want these UK pension and benefit changes explained before the deadline rather than after it has passed. September is coming. The question is not whether every rule will affect you. The question is whether you will know which ones do before they affect your money.